Yeah, in the last hour, Wall Street investors appear to be rattled after the White House said that President Trump is sticking to his February 1st deadline for new tariffs on Canada, Mexico, and China.
Now, meanwhile, there's also the risk that all of this could lift gasoline prices because Canada is the biggest source of foreign oil into the United States. The U.S. imports about 4 million barrels of oil from Canada every single day. Look at that. That's 4 times as much as what is imported from OPEC. Mexico is also a major source of foreign oil. And
well, I think, tariffs are the only negative of Trump's economic agenda, most of which is very good. I also, by the way, wouldn't completely give up hope on a settlement. I know a number of people, including myself, that have been in a jury room, selected for a jury, and we're ready to go. Lawyer comes in the last minute and said, hey, we have a settlement, and we all leave.
You're up there by Canada, actually, so you know a thing or two about all this. You're also on the Ways and Means Committee, which has something to do with trade and so forth and so on. Your first thoughts and impressions about this tariff story?
Well, first of all, I agree with you, Larry. It is a national security issue. I do think that we need to change the behavior. We need to bring our supply chains back, and I think tariffs are going to help in that.
Well, the ink is not even dry from Donald Trump's inauguration, and he is already putting in some hefty tariffs. Definitely going to cause some political tension as well, and I think that's the most important thing we need to think about in all of this. Let's think about the headlines that can come out. Yes, this could be inflationary, but past tariffs have also shown that they might not be inflationary, so nobody really knows on this. As of right now, Trump will be implementing 25% tariffs on Mexico and Canada, as well as a 10% duty on China. The illegal fentanyl that they have sourced and allowed to distribute into our country is one of the main reasons why Trump is raising tariffs. With this news, it immediately sent markets from the green down to the negative as we close out the week. Now, this news came following a Fed's decision to keep interest rates steadfast while we got a higher PCE, meaning that could we see inflation tick up again even without these tariffs on the table? A lot of people think that these tariffs could be inflationary and believe that this is a $1 trillion game of chicken taking place. Taking a look at the United States GDP in perspective to other countries, we can see here that we are dominating at the top end here, sitting at nearly a $30 trillion GDP. And obviously, one of the countries we just put a new fresh tariff on is China, one of our largest competitors when it comes to growth and when it comes to technology wars. And I do think a big part of these tariffs are being leveraged on a technology war. We want to start insourcing more stuff, be more reliant domestically and not so much reliant on foreign entities because it seems like there has been a tremendous amount of data breaches. So tariffs will now give the opportunity to start creating things more in-house, but the initial knee-jerk reaction is that this could be inflationary. Come down to Canada, we can see that Canada produces about $2 trillion a year in GDP, which means the United States produces 14 times more GDP than Canada. And we come down to Mexico's GDP sitting at $1.8 trillion. When we take a look at how much Canada is reliant on the United States, basically 70% of Canada's GDP is reliant on exports to the United States. Now, of course, this is going to impact the US. Talk about minerals, oil, fuel, vehicles, machinery, and other very important commodities. Mexico is so reliant on the United States, making up 73% of Mexico's GDP. So we see here that Canada and Mexico are very, very reliant on the US to keep doing business, which tells me that the position of power still lies with the United States. Now, granted, this definitely could be inflationary. Nobody really knows. The market is actually saying that it most likely will be inflationary, especially after the hotter PCE reading that we had and the fact that the Feds are keeping rates where they are. In the short term, I definitely think this could be inflationary, but in the long term, I do think it could create more opportunity within our country and us producing a lot more internally, which of course could be more expensive. But the biggest problem we're seeing here is deficits. During COVID, we were running $2.5 to $3 trillion deficits. And during the Biden administration, when things were still running strong, we were still running over a $1.5 trillion deficit. So as of right now, there's multiple reasons why we could see that these tariffs are in place. We're watching the government workforce definitely be on the table for cuts. We're watching tariffs now being added. I am not for or against this. I am just laying out what I am hearing and the facts that are given to us. Let me know what your thoughts are on tariffs being implemented here. Do you think that this is just a hoax? Do you think that this is a negotiating tactic? Do you think that this is serious, or do you think that this is going to be implemented with high inflation around the corner? Let me know what your thoughts are down below. But what I will tell you is this could lead into a triggering of a spike in the 10-year treasury. We have the PCE coming in a little bit hotter than anticipated, and the 10-year treasury started ticking up with the news of tariffs being implemented, which could be inflationary, and we watch stocks sell off. A lot of investors are saying that 5% mark is a key level to watch for risk assets, meaning that if we break above 5% on the 10-year treasury, basically your risk-free rate, we could see a pretty substantial sell-off and a competition for stocks at this point in time with the lack of growth. Now, if you haven't been following, GDP grew at 2.3%, which is still strong, but it is a lot less than anticipated. We were looking for 2.5% growth rates, considering that we've had plus 3% growth rates for the last couple of years. This is definitely a turning point when we look at GDP and we start talking about yields going higher and the implementation of tariffs, which could actually slow down the economy even more. Now, here's the odd thing I really want to point out. We all know asset prices are high, regardless of what you look at, but that's with the expectation that growth rates are going to be high, so we have to pay a premium. But what is actually taking place underneath everything is what I believe is a little unhealthy here. We're watching junk bonds, which are considered a little bit more risky, basically getting between 4.5% to about 6.5%. Now, that's with default risk, which is making me scratch my head and letting me know this is actually getting close to 2007, 2008 levels. Why would you take on 4.5% to possibly 6.5% risk with a possible chance of getting defaulted on when we're starting to push nearly 5% risk-free with the government security backing that asset up? And this is where we're starting to see tightening in yields. And this is concerning to me because this is kind of where 2007, 2008 was, where essentially you're not getting paid to take on the appropriate risk here. So I know I pointed this out a few times on the 10-year treasury. Now, the one thing I do want to point out is we could be looking at a new bull market for treasuries for an extended period of time. We haven't seen a top here, and it definitely looks like it wants to break out. It wants to go to newer highs. We literally have to go back to 2007 levels to be at a 4.5 to a 5% 10-year treasury. And it looks like it may want to go even higher. Now, I don't think we're going to see 7, 8%, but with the deficits that we're running, and now with inflation peaking up higher and these tariffs on the table, I think anything's on the table as of right now. As always, ladies and gentlemen, appreciate your time, and we will see you all in the next one.